Thank you for tuning in to another tutorial. In this tutorial, we're going to be looking at how to trail your open positions. The first thing you're going to want to remember when you're accessing your weekly pulse wave price triggers is you want to take inventory of what you have before you. As you notice here at the bottom, we have a few additional tabs. The securities tab is your main tab that has all the securities listed primarily in alphabetical order by ticker as in column N. The main tab is going to be your advanced filter tab. The advanced filter tab has all the securities from the securities tab, but in this case initially they're put in alphabetical order too by ticker, but you can use the search feature to look for a particular ticker symbol, or you can type in anything here, and we've done tutorials on this before, so take a look at those uh, for reference, but that's not the purpose of this video. The purpose of this video is to look at our stop losses, which is going to be column F. So let's take the first one here. Let's just use Apple since the first thing on the list. All right, so let's say you've been long Apple. Let's say you got long Apple when it hit $100. It had fallen to $94, and you got long when it reached $100, and you've been riding it up ever since. And then you get your sheet, and you're looking at this sheet, and the sheet is telling you that the next pulse wave to buy is at 114.31. All right, well, let's say you're already in it and you're looking to add to your position. This is where you would add to your position at this next pulse wave right here, 114.31. The initial stop for this trade is at 112.25. Now, if you're already in the trade, the 112.25 is where you're going to move your stop to. There is a general rule of thumb that you should employ when using stops. The first rule of thumb that you're going to want to, just something to think about, is if you're long a stock, let's say a $5 stock. When I mean by $5 stock, I mean that it's trading within, $1 and $5 a share. All right. So if you got a stock that's $5 or below per share, and you have 500 shares in the stock, the most you can lose is 500 bucks, right? Um, because you only have 100 shares. So if you have 100 shares of a $5 stock and it goes from $5 to zero, the most you've lost is 500 bucks, correct? Because that's what 100 shares is. It's dollar for dollar match there. So it's $500. So in most cases, depending on your account size, it's not going to be necessarily beneficial to even put a stop in there. Unless you believe the company is going to zero, you can sit there and just buy it and hold it and ride those waves out. That's traditionally a technique that is used, because in that way you can't be stopped out, and it's not going to rip your face off if it goes from $5 to zero, because that means the company's out of business. All right. The only risk in that scenario is that it could become a penny stock and trade at pennies and never come back up. That's a possibility. But just as a rule of thumb, that's just something to think about. Another thing to think about too is, in general, if you buy something, let's say you bought a stock, like in this example, let's say you were long from 100 and you've been trailing your stop all the way up. Well, 112.25 is the new stop. Each week when you get your pulse wave sheet, this stop price is going to be updated. It's a volatility stop. Sometimes they widen, sometimes they narrow. You're only going to move your stop when the suggested stop price is above your last stop price. So let's say last week you trailed the position and your stop loss is at $110. Well, this week's sheet is higher. It's now locking in 112.25, so that's $2.25 more. You're going to move your stop up. Okay, locking in more profit. That's how you trail your position. But let's use the same example. Let's say last week the stop loss was $115 a share. And then this stop is 112. You're not going to move your stop down to 112. You're going to keep it at 115. You only trail and move your stop higher, never lower. You never lower your stop. You always move it higher, okay? That's how that works. From time to time, we will do intraday updates that will show where to move a stop intraday. Sometimes things change intraday, and it will call for tightening up the stops and locking in further profit. So when you're already long something, that's what you want to do. You want to use this field to lock in and trail positions. You never lower the stop, you only move it higher. If the stop does not move higher than where you already have your stop, then you do nothing. It's really just that simple. So if you're long a stock, here's your stop loss column right here, column F. You move your stop along with this column. That's how that works. Now the next rule of thumb that I want you to take a look at is looking at parabolic moves. Sometimes a market will move in a parabolic move. It'll move several dollars. Let's say you were long, again, using Apple. Let's say you got long at the 114.31 pulse wave, and it rallied from 114 to 124. All right, that's a $10 run. Well, if it did that in a day, and let's say it did it before the next adjustment sheet comes out, obviously you're going to want to lock in that profit. You're going to want to move that stop, move your stop loss as tight as possible to lock in as much gain as possible. But you got options. You don't have to just move it up and get stopped out, and you don't have to just jump out and take profit. What you should do though, at minimum, is at least move your stop to break even. So in that same scenario, if you got long at 114.31 and the stock ran to 124.31 in a day, you're not going to keep your stop loss at 112.25, because that violates the take what you can, give nothing back rule. You never turn a winning trade into a losing trade. You at least move your stop to break even plus commissions. So what that would mean is you move it to the 114.34 and factor in commissions, and let's say whatever broker you're with, that could mean moving your stop, let's say, to 115. This is using an arbitrary number. So you go ahead and move your stop to 115 and let it stop there. That way, if you're stopped out, you haven't lost anything. All right, you don't gain that $10 move, but you also, if it pulls back, you don't lose anything. You never want to turn a winning trade into a losing trade. I always recommend moving that stop loss not just to break even plus commissions, but I would move it into lock in profit plus commissions. So that's how I would do it. Lock in a few dollars. So if it moves $10 in a day, you may want to at least lock in like 8 of those $10. Okay, that's how you want to do that. All right, so you don't want to be greedy. And what I mean by greedy would not be taking the money and running. That's not greedy. Greedy would be like, oh, I'm not moving my stop, I think it's going to keep running. That's greedy. You need to take what you can and give nothing back. Let tomorrow worry about itself. Well, what if it gaps up and runs even more the next day? That's why you have the pulse wave, so you can catch those moves. And that's how it works. So if the market did move $10 in a day, that means the next updated sheet that comes out at the end of the day or before the opening bell the following day, these numbers here are going to be adjusted and tell you what to do and how to handle that. That's how that works. Okay, so we never chase markets. We just don't do that, and we must practice discipline and moving our stops. If at any time a market does have a parabolic move, or there's something in your portfolio and you have a question and would like for me to do a portfolio analysis, so to speak, and you want to know where I think you should move your stop, just go ahead and shoot me a line. Shoot me a message in the trade room. Say, what do you think? And I'll pull it up and I'll tell you, just quick, fast, in a hurry. That's what we do. That's why the trading room exists. So if you have a question about an open order position you have, and you want to know, should I take profit? What would you suggest moving to stop because it had such a huge move in a day, and the updated sheet is not out yet? Just hit me up and I'll tell you. Okay, it's just that simple. Sometimes you have to do that. Sometimes the markets move and pay you a bunch of money at once, and you take it and run. That's generally what I do. I take the money and run. I like to I like to go home flat on the weekends. When Friday comes, no matter what has happened, I like to get out and take my money and run. Live to trade another day. Whatever the market has given me that week, I would like to take it. I only go home with insurance when we have some economic uncertainties, where there's a lot of rumors and things going on. Then I'll go ahead and I'll take home some insurance and tell you what that means. If I think that it could affect the stock market going down, I may go ahead and get long some SDAO or some SPXY or UVXY, something like that. A few shares just to see what happens if I think there could be a Black Monday because of some shenanigans on the weekend. So I do that from time to time. That's not an every week thing. That's just when, like when we had that Brexit thing and I did the videos telling everybody, giving everybody the heads up. We went ahead and we did what we did, and a lot of the stuff was off sheet because my experience and my background, I know what's what and what to look for. So we went ahead and we just pimped it. That's a one time thing. That's not something that you can set a system around. If you know what I mean, you can't make a dogma out of that and say this is what we do every day. No, that was a once in a lifetime situation that you were able to take advantage of. So for the purpose of stop losses, this is what we do. We stick to these stops right here. You place the stops at the time you place your trade. For more on how to execute these trades simultaneously, see the videos on order types, because then in those videos I actually show you how to use certain orders, and I explain to you what those orders are, what they do, some of the pitfalls, the pros and cons of each type of order, and I go into more depth on that. In this video I just wanted to explain to you the stop loss and how you trail that. That's how it works. Each day the sheet is updated just to see, for stop loss purposes, just to see what's what. Another thing I want to point out too, every updated sheet that you get each day throughout the week, you want to look toward the master sheet that you get Sunday night and put it against that for entries anyway. I like to use the Sunday night sheet as my golden sheet for the week for entries, but the daily updated sheets I use for my stop losses, because that's more dynamic to what's happening in the market, and that'll help me know where to move my stops. Does that make sense? So, in review, in a nutshell, the sheet that you get Sunday night, that's the sheet that you use to enter the market. Those are your main pulse waves for the week. The daily end of day sheets is for stop loss adjustment, so you control your open positions. I'm not saying you can't trade off of those updated sheets and use those pulse waves to get along the market, because you can. The system is just that flexible and dynamic. I'm just telling you what I like to do. Another thing too I want to point out while we're talking about stop losses, get used to the in play tab. This in play tab is a handful of securities that I watch. Okay, it's just a handful of securities. This is what I watch. I don't watch a whole bunch of stuff because I don't need to. And really, I could trim this down even more. I just put this on here for you all, just so you could see. But really, all you need is the UGLD, the USLV, the TMV, and the TMF. These are your bonds, long and short bonds. FAS, that's your financial sector. JNUG and JDST, junior miners. Nugget and Dust, the big miners. The hack, self-explanatory. SVXY, if the stock market is bullish, you just go long that. UVXY, if the stock market is bearish, you go long that. TQQ, the long NASDAQ. SQQ, the short NASDAQ. And then, of course, WTI, the U is the long when oil's going up. The D is the short when oil's going down. That's it. Just going long and long these stocks right here is all you need. You don't even need to use this side of the sheet to sell short side. We'll get to that, and I'll show you techniques on shorting. But when it comes to equities, it's hard to borrow shares sometimes. Even some of the most liquid stocks. I remember TLT, which is one of the most heavily traded instruments on the planet, like the SPY, which is the S&P 500. That I was getting errors saying that they couldn't locate, shares to short when the bonds were taking it on the chin. I wanted to ride that, and I couldn't. I really wanted to hit it and just couldn't. The TBT wasn't, which is the inverse of the TLT, wasn't barely even moving right, and I wanted to just go flat out to short the TLT because it would be down like $1 or $2, while the TBT would only be up maybe 50 cents. And they say, well, it's a percentage thing. Technically speaking, it's the same percentage. It just is, nah, see, forget your percentage. I rather, I want dollars. I don't care about percentage. I care about bucks. I'd rather capture $5 on a trade than 50 cents. Yeah, I know you can go more shares on that 50 cents. But then with the more shares you trade, that's more leverage and more risk if you're wrong. I'd rather just go out and control my leverage and take that $5. That's just me. But anyway, I digress. So technically speaking, I could hide this and not even use this part of the sheet. All you really need is B to G. That's it, man. That's really all you need. And I just wanted to point that out. So this is your column right here, man. Stop loss. Use the updated sheets throughout the week, and as these move in your favor, go ahead and use this to move your stop. It's just that simple. Super parabolic moves when the market's moving a lot. Ask me intraday before the updated sheet at the end of the day, and I'll tell you what I'm doing. But really, this in play tab is what I'm watching. This is the stuff I trade and watch. So just wanted to put that out there for you guys. Okay. So there it is, and I know that that silver really doesn't have a good inverse 3x ETF like gold does. Gold has Nugget and the J's. Okay, all you have is the long triple silver, which is the AGQ. That's really all you got. You know what I'm saying? So it is what it is. Sorry about that, but that's just how it is. There's really not a good inverse. But just know this little nugget here. No pun intended. If gold is going down, gold and silver for the most part move together like 100% of the time. So if silver is going down, chances are you can go long dust or go long JDST. If you go long JDST or dust, you're basically shorting silver and gold at the same time because they pretty much move together. So that's how you play the downside of the silver. Just throwing that out there. Just stick with these two right here, okay? All right, that's it. So again, here you go. That's it. It's very simple. All right, see you in the next video.